self-directed retirement plans really allow you to invest in anything allowable by law. And
Yeah.
people are like, well, what is that list? And it's like, well, I mean, you can't really list it. There's a good list of what you can't do. There's really only three things. Don't invest in life insurance policies or contracts. Don't invest in collectibles. Don't invest in subchapter S corporations. But literally anything else is on the table. Hey, everybody, welcome back to the show where we help investors think beyond the traditional playbook and understand that building wealth doesn't have to mean relying exclusively on Wall Street, mutual funds, public markets. On this podcast, we explore the world of alternative assets and bring on operators, strategists, and experts who really help investors see what's possible outside the conventional financial system. Today's guest, I'm really excited about. We have Ryan Foncannon, founder and managing partner of Swan Virtual Family Office. Ryan's work is really centered around, from what I can tell, helping affluent clients, business owners, high income earners take a more proactive and holistic role or approach to wealth, especially through advanced tax planning, coordinated strategy across multiple areas of their financial life. Swan describes its model as a virtual family office built around integrating planning rather than the fragmented advice, with capabilities spanning tax, business advisory, financing, legal and charitable planning, insurance, wealth management. Ryan, you really do it all, and I can tell that you do it well. Welcome to the show, and thank you again for lending us your time.
Absolutely, Nick. I appreciate being here and everything.
Yeah, again, glad you're here. I really think this is going to be a valuable conversation because a lot of our listeners are actively trying to move beyond the default stocks, mutual funds only mindset, but they also want to do it intelligently, right? They want to understand how tax strategy, planning, and capital positioning all connect to this world of alternative investing. And I'd really love to just start with your background.
Yeah, absolutely.
Yeah.
It's like, where do I start in my background? So yeah, I appreciate that and everything. Yeah, I'm kind of a unicorn. I've got like a background in a lot of different areas, and sometimes it looks like it's unrelated to each other and things like that. So yeah, I've got a background that we've got our own RIA. We've got a new venture capital group that's doing a lot with pre-IPOs. We were talking about alternative investments, and those kind of fall in line with those things. Got a background in insurance, everything from, doing Medicare supplements for some seniors to more sophisticated planning, whether that's, health insurance, life insurance, annuities, disability, maybe some Swiss Army knife type of strategies that also have some tax elements to them too as well. And then I've done a lot of business advisory, so dealing with, lowering labor costs, non-labor costs to other types of business advisory, valuations, different things like that. And then we're not, I'm not an attorney, but we've got access to a lot of different types of attorneys. So it's just dependent on, what somebody needs. And sometimes they need multiple different types of attorneys. Maybe they've got a very sophisticated estate.
Yeah.
All the, people have like, different families, the blending, all the different things to business planning. And we're getting more and more people in the international areas too. So that adds
Mm.
another element. Like maybe they got some assets. Maybe they're second generation, third generation. There's some assets in a different country. How do we protect those assets from the ones in the U.S. and vice versa, kind of thing? And then I'd say probably the biggest opener for us is the advanced tax planning that we do. So we're talking to folks, business owners, high wage W-2 earners that they're not able to find the other deductions since they don't own a business, and or large capital gains events, especially ones I would say sweet spots $1 million plus. But we can do something under that and all of that. So it's just kind of bringing all these other options to the table. And that kind of creates the budget that you're kind of talking about the alternative investments and things, saying, hey, we've already repositioned what you were going to pay Uncle Sam legally with some
Mhm.
different strategies and everything. And then we can kind of use that as part of the budget for the wealth building and everything. And definitely the different things that you all handle is definitely the self-directeds and things like that. That's definitely on the table for us to explore and everything.
Awesome. Yeah, and so all of that experience really brought you to creating Swan Virtual Family Office. Can you talk? I know one thing that stood out to me when I was looking at your model is that you're not really approaching wealth in this siloed, pigeonholed way. A lot of advisors do stay in one lane, tend to, hone in on one, investments only, insurance only, tax only. But Swan, I mean, it really, like we talked, like I mentioned, it seems like you are really bringing this multiple disciplinary approach to it. That seems to be a big part of your philosophy. Um,
Absolutely.
yeah,
Yep.
what did you I guess what did you see in the marketplace that made you say people do need this more coordinated approach than what they're probably currently getting?
Yep. And that's a great question. I would say even going back, I used to be more of a captive agent or captive advisor that, I was kind of handcuffed. I was being told by whoever I was working for that you can only do this or you can only focus on these things, or we don't offer those things because it's not very profitable, even though it may have been the best option for the client kind of thing. So I ended up going independent back in October of 2011. And going back then, I kept hearing even some of my own clients, whether they were business owners or high-wage W-2 earners or large capital gains events, that, they kept being told, hey, just pay the tax.
Mhm.
Or, max out your HSA, your 401k. It's like, okay, well, I'm
Right.
making $1 million plus. That's not really going to put a big dent
A
when I'm
big
paying
dent
it.
in the
Yeah,
tax
yeah,
bill.
yeah,
Yep.
yeah. And then I see the billionaires who are legally or hopefully legally for the most part, paying
I
little to
think
no taxes. And it's like, well, they're doing something. And I know those things are out there. So I just kind of went on this journey to go learn those things and find those things. And I get little nuggets here and there. I've read a gajillion books, webinars to conferences to just, networking, all the different things of finding these different things. Going back to 2011 and everything. Something that I've learned also that I think being more collaborative here, kind of like in the 21st century, is that we've got access to 100 different specialists and everyone's got their own little niche. It's kind of like, okay, from our perspective, there's always like, we're always in the pursuit of the better answer, whatever that
mm,
better answer is. And I think it's a big part of like the better answer is just having, well, what are the options that are on the table? And like you were saying, a lot of people get sideload and they're like, well, I can only offer this. And sometimes that's also, they can only offer certain things because that's what their employer says they can offer. Their hands are
right.
tied and things like that, or they don't have the background. And unless, or they might have people that work within that, that structure. Let's just say one of the big wirehouses, maybe they have an advanced tax planning unit or something like that, but you have to be making tens of millions, hundreds of millions of dollars to probably even get in front of those people. So
Mm,
something that we really wanted to do was kind of bring, some of those strategies from Wall Street and bring them down to Main Street. And in a lot of cases, they can be very, very helpful. Some have caps to them, some don't. Those are all kind of like IRS regulations and things like that. But just kind of being able to work with other advisors, I think, is a big thing for us. Now, sometimes other advisors don't always want to work with us because they see us
sure.
as a threat.
Right.
So it's more adversarial, and and I think a lot of people experience that even when they try to get like their CPA and their financial advisor and their attorney, and everybody's kind of got giving the other person kind of the side eye and stuff like that, and not
Mhm.
everybody's working together, kind of rowing in the same direction sometimes, and things like that. And I think a lot of just over the years, we've built out a pretty good network of people that we work with. I think we probably do business with about 50 plus tax practices nationally, and then the network from there, different attorneys, and all of the things that I was kind of talking about before. So definitely trying to be more collaborative and try to find better answers than maybe what's already been presented, or if there's been anything presented, I guess, and all of that.
Yeah. Yeah, I think that's super smart, and I think a great way to approach that side of things. I think the phrase virtual family office, I mean, to me, it sounds super sophisticated. I'm not entirely sure what it means, to be honest. But I think a lot of people would hear that and ask the same question. If you don't mind explaining, what is a virtual
Absolutely.
family office? How does that differ from just like a traditional family office?
That is a great question. So I think the Rockefellers, if they weren't the first family office, they were one of the first major ones here in the United States. And the idea with that type of family office is that they have everybody under one roof. So they've got the tax attorneys, they've got the real estate people, they've got the wealth managers, securities people, CPAs. They have everybody under one roof. So everybody's on the payroll essentially. And what I found is that in most cases, when you're trying to deal with the best of the best, a lot of them are independent. So they're not necessarily, it's not like Goldman Sachs just corner the market on the best people that are available. It's not saying that they don't have good people there, but just saying that a lot of the ones that are a lot more collaborative and have more of a wider, I would say, playbook of things to work with. So it made it easier for us to partner with those different people and bring them on as needed. So then that way they're not under, they're not on the payroll necessarily. So it's a little bit cheaper. So we've even worked with some actual family offices that were like, hey, we'd like to leverage you guys just because you're a lot more efficient from even just a cost standpoint, but then also the strategies that we can bring to the table. It's not something they had in-house as well. So that's what kind of makes us, I think, a little bit different, that, we're able to identify all these different people we can bring to the table, but we don't need to bring everybody to the table, kind of thing. So if someone's a doctor working for a hospital system making 7 figures plus, he doesn't need all these business advisory type of specialists to the table. It's like, okay, we don't need that, but then, they need some other stuff, the tax, the estate planning, asset protection, things like that. We can bring that to the table.
So just make sure and reiterate here. So you're bringing CPAs, advisors, attorneys, insurance people, business consultants, all together, all those solutions together, to keep it from being this fragmented approach. And maybe this is an obvious question. Beyond the cost and beyond the just the efficiency, is there anything else that makes this matter so much, especially for high income earners? It sounds like you deal mostly with these high net worth individuals, high income earners, business owners, and investors.
Mm-hmm.
Is there any other reasons why it matters so much to branch when people are starting to branch into these more complex assets or strategies?
Yeah, I think that usually we start with the tax area, usually 9 times out of 10, 9.9 times out of 10, that's the major pain point. So we always like to make sure that we're solving the pain points that are just like really kind of keeping people up at night, because obviously they've not been solved, or they've not been maybe fully solved. It's like, okay, I've got some help, but I still need some help on whatever that is. And a lot of times the advanced tax planning also helps us show the value. So if we're not able to show you, we're not going to put you in a better position than what you're in already, just paying the tax. We're able to show that value up front. So we're able to also create that budget that, hey, we can redeploy this money into, and sometimes it's maybe just reinvesting in the business. Maybe it's hiring different people to help them scale. It doesn't always have to be the wealth building component, even though that's always an important thing, and saying, hey, we're repositioning what you're already going to pay to the government. We've taken a lot of the risk off the table because that was money you're already giving to the government anyway. So using maybe XYZ strategy, maybe it's 1, maybe it's 2, maybe it's layering 3 or 4 different strategies on top of each other to do the different things that maybe, like, like I was saying, like a Swiss Army knife, like there was a tax component, but, we're getting killed on insurance too. Is there any way that we could do that? And maybe there's some different strategies that we could add to the table, or at least take a look at and say, hey, I think we should explore this. I think there's a way that we can solve the tax issue, lower your insurance costs, and then also kind of create like another bucket for retirement kind of thing. So there's a whole bunch of different kind of interesting things that we can do if we just know what the kind of like the pain points are. So like I said, the tax is usually the big one, but then that leads into all the other stuff. And that's not always so, I would say, traditional. I guess, like you were saying, the non-traditional thinking and different asset classes and things like that have not been considered. So that's a big part of like what we do and everything.
Yeah, and I think that's really what the audience and really the main message of the podcast is, that Wall Street is not the only path. But I think one thing that does get missed is that moving beyond Wall Street isn't about just finding a new asset class. It's about learning to think differently about capital altogether. When you work with clients, where do you feel like you typically see the biggest blind spots in how they think about wealth creation when they are looking to get into the alternative asset space?
I think one, you could do a Google search and come up with 10,000 different
Yeah.
options for alternative. So like the whole alternative space, I won't say it's the Wild West, because there is some oversight, but sometimes the marketing for every one of these things looks amazing.
Yeah.
Like, oh, that sounds great. That sounds great. And being able to, I would say, either being able to discern what to look for. But when you're new to the space, you're like, I don't even know where to start kind of thing. So I think something that we did, one of our partners on the investment side, on the RA, and then also on the venture capital, he's a former FINRA regulator. He helps us. He even helps me like being able to look for stuff, and he can find, I don't know if he has special security clearance, but he can find stuff that, you just can't just come up with a Google search looking
Right.
for something. And he's been very, very helpful in that. So I think people are interested in getting, better than market returns. We're like, but I don't know where to go. And then they're like, oh, they hear about the alternatives, and there's some that are great, some that are not great, some that are in between. So yeah, we go to a lot of like due diligence events, put on by some groups that we trust, and all of that, just to kind of do deeper dives. And we always I kind of like calling it triangulating, making sure they've been checked out by another group and we're able to verify. And then we have another, another party verification in terms of what investments to look at and everything. Not saying somebody couldn't do something super nefarious, but usually you can pick up and find things. Or I know there was, and I can't remember what the name of the fund was anyway, but I know one of the due diligence groups that we work with is a bunch of securities attorneys, and they were like, hey, they haven't even given us their financials for the last 2 years. I'm like, well, that's a major red flag.
Yeah. Don't love that.
Don't love that. Yeah. But that's like something people, you don't know what you don't know kind of thing. So I think also having like a team to help kind of go through that kind of stuff, and at least say, hey, you should look out for this, look out for that. They're like in the gas, we do a lot of stuff in the gas and oil space. There's some great tax benefits to that, but that's also a wide open space. I know, like I saw, like sometimes you get the algorithms on like Facebook and stuff, and then all you see is gas and oil.
Yep. You get
ads or whatever it is. Like, how did I get stuck in this? I don't even think I typed anything. I thought about it. That's a different discussion
your mind now.
Yeah. That's a different discussion for a different day. Like getting in that, and I was, when I see someone saying 40% guaranteed, I'm like, well, I know that's just not possible. It's possible that can happen, but to say they're going to guarantee, it's just
guaranteed is a different word. Yeah.
Yeah. Guarantee is a whole different ballgame of saying up, like a lot of times we'll say up to, and they're like, well, you said 40 and it came back 9. And so like, it's just like, and just knowing like the language of what stuff to look for and things like that and all of that. So yeah, I think it's that we're big proponents of the alternative space. We really love it. I mean, we've gotten access to things, on the real estate side to, like I said, gas and oil, some other, there's some tax strategies, other securities, some aren't. But this having, I think, the access, but then also saying, hey, here's the ones that we've vetted and feel okay with, moving forward. But there's a whole bunch of them out there and everything. And not saying that there's, just because we haven't heard of one doesn't mean it's not a good also as the other, kind of the other part of that too.
Yeah. And that's a big thing in our space too, where self-directed retirement plans really allow you to invest in anything allowable by law. And people are like, well, what is that list? And it's like, well, I mean, you can't really list it. There's a good list of what you can't do. There's really only 3 things, you know, like don't invest in life insurance policies or contracts, don't invest in collectibles, don't invest in subchapter S corporations, but literally anything else is on the table.
Yeah.
So, once you think you got a handle on what that all includes, you'll have somebody come to you. Like we had a client who was like, I want to invest in apiaries. And I was like, I'm sorry, I don't actually know what that means. And I guess it's a bee farm.
Oh, okay. I was thinking a bird thing, but I wasn't sure what
like, right?
Like a bird or
like
a bee.
It sounds
I have any idea.
But
apiary, I don't know. Yeah.
Who knew that people would want to use their retirement funds to invest in bee farming? Like I would never have listed that, and that's not going to go on a list of what you can invest in the alternative asset space. So I think it's important to keep an open mind, and it's just. I feel like it comes down to, at least in our space, is what you know. And I know that's investing advice that you hear all the time. But when it comes to retirement capital, just knowing that you can take strategies and skills that you have and apply those directly to, your retirement, building your retirement capital and your long-term wealth, I think is really cool. I definitely want to dig into one of the areas I think you're especially known for, which is advanced tax strategy.
Uh-huh.
I feel like your firm places a major emphasis on tax planning, and your broader message often is about helping clients reposition money that would otherwise go out the door. For any investors listening to this, help us connect the dots. How can we think about a tax strategy not as just a defense, but as a way to create more investable capital and more opportunity?
Absolutely, absolutely. That's a great question. And I think it's like it comes down to like a certain profile of people. So there's this thing called the standard deduction, and it goes up just a little bit each year. So that's kind of like the hurdle to get over, because someone has to have more. I think, like, let's just say for 2020, I think it was 2025. For a married couple, it was like 31,500 is the standard deduction. So everybody gets that if you're married, regardless of anything. You don't have to itemize or anything. So you actually have to have more deductions than 31,500 to itemize, to file that way. So like that's our threshold. So, usually it might take, 25, 30K plus to put into something to be able to get the tax deduction that then gives you enough tax savings that you're actually coming out ahead. And that's a big thing that we do. And usually with like just through the advanced tax planning, the big thing, the three things people want to know, they want to know how much is it going to save me versus paying the tax. And then we got a way of doing that. How much is it going to cost me? And then what's my net benefit? Essentially like, okay, with the cost, how much am I coming out ahead on it? And each strategy that's out there is a little bit different. It's not just one thing goes across the board. There's some charitable strategies. Some have a cap of 30% of your AGI or adjusted gross income, which for people that are, not real familiar with AGI, that's like basically like if you just had a pot of all the money you made. So W-2 income, if you have investment income, maybe rental income, whatever it might be, all into one pot, and that's essentially your AGI. And some strategies have like the AGI needs to be 500K plus. Other ones are 50K. I'd say a lot of them are probably 600K plus. It's kind of a good sweet spot because like the standard deduction is going up a little bit more this year. I think it'll be like 34,000 off the top of my head for a married couple and things like that. So there's that hurdle that we have to get to. But there's a lot of different ways to get that. Some tax strategies are very, like the IRS would say, we don't want you just doing it for the tax benefits, but a lot of people do it for the
Right.
for the tax savings. Let's not kid anybody, but
there's a reason they're saying that. Because
there's a reason they're saying that. Yeah. So some are just like a straight tax play, and some are charitably inclined, and then some have the tax deduction, plus they also have maybe a cash flow component to it. And the cash flow components are all a little bit different. Some are fixed, some are variable, just depending on what the distributions are. Like gas and oil can be very variable compared to something else that's maybe just paying a flat 5% or 6% of what you put into it, kind of thing. And then the third one is what we would call whether it has like an exit or like an appreciation leading up to an exit. So maybe the exit, maybe you add that into the mix. So now you're looking at, you're getting enough for a tax benefit, you're getting some cash flow in between, and then there's a potential for an exit in 3 to 6 years. So there's a lot of kind of cool things versus just, kind of paying the IRS and not really seeing what that's going to. Now we're not big. I would say we can get people down to 0%, but we usually unless someone wants to get like tax opinion letters and some other protections and things like that, we like leaving a little meat on the bone. It kind of keeps the federal and state governments kind of happy and everything like that. So, and I think what I've seen, if somebody has an AGI of like 60,000 or more on their tax return, even with the deductions and stuff, that it lowers the chances of an audit significantly. Not saying it can't still happen by chance, but just from I got some different tax professionals I work with that work in tax resolution and stuff, and they say, hey, yeah, at least leave a little bit on the bone. So a lot of times we could go lower. Not saying we haven't saved people 95% on their tax return, but sometimes leaving a little meat on the bone just kind of keeps everybody happy, and nobody wants to go through an audit or the financial colonoscopy, as we call it. Or the tax colonoscopy.
That invasive, fun process.
Yeah.
That's a good comparison.
Yeah. Not fun.
And I guess without getting too technical or into too, specific personal advice, are there common strategies or tax mistakes that are missed opportunities that you see from business owners or high income earners, like that are happening over and over and over again, like the usual suspects, I guess I would call them?
Yeah, that's a great question. I think so. So some tax strategies, I'd say most of them, they're kind of agnostic or just about the numbers, but there are some. Like if somebody, like one is like a work opportunity tax credit, or they call it the WOTC. And I see this one get missed a lot. And a lot of times, a lot of payroll softwares will actually pre-qualify people that are applying for different jobs with that company. You'll be able to know up front what type of tax credit you can get. Just a lot of people it just needs to be activated with the payroll service and stuff. And the tax credit could be worth anywhere from $2,500 to, I think, as high as 20,000 per employee. But a lot of the, like a lot of construction places, healthcare, some other places that hire, could be anything from a parent getting some like Medicaid help with their kids. Not saying the kids are on Medicaid, but sometimes they can get on Medicaid health insurance, but not fully on Medicaid, any type of state aid. Someone that hasn't worked in 6 months, veterans, certain types of veterans qualify if you're hiring those types of people, ex-felons. So there's a lot of different people that will qualify for that. That's kind of like a smaller one that not a lot of people, I think, talk about. So that's one for like a lot of business owners. And then I'd say on the something else, there's also for business owners, whether it's a single business owner or maybe just a few business owners and stuff, that going beyond the 401k.
Right.
Not just, but a self-directed, definitely. I think that's definitely on the table because it just opens up a wider array of investment opportunities. And a lot of these, even if you do a cash balance pension plan, profit sharing, they're still limited by like who you're going through, and especially like the service. Sometimes they want to cut down like what you can invest in just to make it simpler. But it doesn't mean that you're going to get better returns. I know I remember when I first met my wife and stuff, and I've had other clients that they'll have like the 30-year, 20-year invests, or, like kind of like you're investing in that fund. So that way, by the time you retire, it's supposed to do really well or whatever. But a lot of times those are off track when you really kind of break them down, and they're too heavy. I think sometimes, like some investments from my standpoint, I like bonds, but I don't love bonds. Like I think sometimes they end up being more of a weight in terms of growing your wealth than they are really actually mitigating it, the risk and everything like that. So kind of like looking at things that way, and kind of like we've even done this probably in this last 6 months of breaking it down to where we've got, I think a lot of people are familiar with like a 3-bucket system. Like our 3-bucket system that we're kind of calling the high risk bucket more of like a mitigated high risk bucket. So we're not just throwing money at something and then if it hits, like angel investing or something where, oh yeah, we did it. We're like looking at more like kind of late stage, like SpaceX or other companies that we can get a hold of some stock, but they haven't went public and things like that, or whatever the other alternatives are. But kind of looking at that mitigated high risk, looking at the middle bucket, kind of like the income bucket. Let's start replacing some income today, just in case another pandemic happens or whatever. That you've got some extra income coming in. And then, because I think a lot of people wait too late to start thinking about income in terms of like retirement, and then the options aren't as great. It's like, okay, I can put you into an annuity or I can put you into something else, but that something else might also carry some risk with it in terms of the, like whether it's paying dividends or whatever it might be. And then like the kind of like the fixed bucket, making sure that they are maxing out the safe money. I think a lot of people have a lot of money in like savings accounts at banks or CDs and stuff, but they're above like what the FDIC will cover in terms of insurance. So there's there's some different ways. Like we'll call it a cash sweep account, that it's kind of interesting. They're able to do micro deposits across 1,500 banks. So then that way you're not maxing out the 200K, or they can go up to 200K at each bank, and it's all done electronically. So there's not, like someone's not manually doing it and everything, and the algorithm resets every night, and they kind of adjust the deposits across all these 1,500 banks, but they can get like the higher interest rate, but then you also have that protection of the FDIC. So it's like even little things like that, or even incorporating investment grade life insurance, or, with the recteds, it's like, hey, let's also, sometimes it's like on the capital gain side, we do so much planning. We're like, hey, don't worry about the big capital gain, or maybe we put in some more advanced planning. private placement life insurance or something like that, just depending on where the money's coming from and say, oh, okay, well, this is for like the money that's not in qualified plans, and you move to self-directed. Hey, we have now some non-qualified, and let's do some interesting things that way. So there's a whole lot of different ways to kind of look at things and think outside the box. And I think we've had some pretty good luck. Even I've used the 3 bucket system myself, so not just telling people
Yeah.
to do certain
Practicing what you
things.
preach.
Yeah, practice what I preach, and I've already replaced quite a bit of my own income, so I'm definitely more well prepared if something happens. With like being a business owner and everything, and having another pandemic happen, we're in a much better spot and having to worry about when and if the government might step in and do something. Like we'll have some money coming in and things like that.
Yeah, which is super important to be prepared for anything. I guess when you're looking at these investors, entrepreneurs that you have, high performing clients, when you have the best of the best, I guess that you've seen, we're tending to make smarter long term decisions, or whatever it may be. What do you see that they're doing differently from investors who may not be experiencing the same type of success?
Mm.
Or I guess, how do they think differently? What do they
Yeah,
do differently? How do they think
yeah,
differently?
I think that's a great question. I think they think on their own a lot better, or they're curious. I think that's always a big. I'm always a curious person too. That kind of got me to where I'm at and everything, just
Yeah.
being curious and thinking outside the box. And they've explored different things, even crypto. We've got quite a few clients that they've done. I mean, I had 2 clients last year that did 20 million plus in crypto. So I'm certainly not going to be the expert to talk to them about crypto. I'm like, hey, you're doing a lot better than I ever would have done at crypto. So I'd rather listen to you. But I can help you because they wanted to cash out, which is amazing for them. But all of a sudden now they got this big tax bill. I go, I can help you with that. And then we looked at a couple other things with at least exploring different things. So I think we're always listening, open to listening to other people. We don't know everything. I think the more I learn, the less I realize I know, kind of thing. Because the world's
Yeah.
just so grand, and that's I think a lot of them will leverage different people, or they're always, like I said, like I think being curious is a huge thing because they're just trying to find that better answer or another answer. And we get a lot of people like that are just curious, that are like, I know there's something else out there in terms of planning. I just don't know what that is. And I hear you might have some other ideas that other people haven't talked about. So I think definitely being curious and exploring things and reading books or traveling for conferences or different things, trying to get more information. I think that's a big thing. I think a lot of the clients that we work with are, and I think a lot of them too are, hey, I'm really good at this, but I'm not good at really what you know how to do. So a lot of
Bridge
times,
the gap.
bridge the gap, and willing to at least be open to having a conversation, know where it goes from there, that kind of thing. But I think being curious, and then also just having like an open mind, I think too, just 2 really big things that kind of sets them a little bit apart, and how they've been able to really, a lot of cases, use other people's money to do different things, start new businesses, roll money into, kind of even using the tax planning to go into the wealth planning, goes into all the other different things that they're interested in and things like that.
Yeah, and I would 1,000% echo the curiosity being just, I think, a character trait that is super important to finding success, because that ultimately is going to lead you to the knowledge. That knowledge is ultimately going to give you the ability and the power to take advantage of these things that if you didn't know, you just didn't know it.
Yeah.
But I really love that. I too am just a naturally curious person. That's what also led me to the self-directed retirement space. What I thought I was applying for just a regular banking job turned out to be not a regular banking job in any way. I don't know anything about traditional banking, but I know a whole lot about people using their retirement capital to invest in all sorts of alternative assets that they know best. So yeah, I think curiosity is a really amazing character trait to practice and to put to work in your life. And I think, I mean, Ryan, this was excellent. I really appreciate you coming on. I think one of the
Absolutely.
biggest takeaways from today's conversation is, beyond, just moving beyond Wall Street, which is what this whole podcast is about. But it's also about building a smarter framework around your capital, meaning understanding taxes, planning, like you mentioned, finding those alternative investments, but But yeah, building a smarter framework around your capital and how those pieces all influence where your money, what your money can actually do for you. For any listeners who are interested on the perspective that you're providing, or are looking to reach out to you or hear more from you, tell us where we can find you and where we can
Yeah.
connect with you.
Yep. I'm on LinkedIn. I'm on Facebook. I would say probably like our website's a great starting point. So Swan VFO, Victor FO, or Family Office. So
I always think I know
yeah.
the phonetic alphabet, but
Yeah,
then a
I
letter
wasn't in the
always will come and
military,
trip
so
me up.
I always, and my military friends always look at me like, Ryan, could you just learn it like that? So yeah, Victor,
Right.
Frank, Oscar, I think, on the Swan VFO. You can definitely contact us there, or info@swanvfo.com is also, if somebody wanted to get in touch with us and everything, and be happy to have a deeper conversation about whatever.
Awesome. Well, thank you again, Ryan, for lending us your time, your experience, your expertise, and your perspective. Really grateful for having you on today.
Yep, I appreciate it, Nick. I appreciate your time and everything and the invitation.
Absolutely, my pleasure. Thanks again, and we'll see you all next time.
All right.